Use and ethics of transfer pricing. Purpose and role of transfer pricing. Transfer pricing refers to the valuation of goods and services exchanged between divisions within the same organization. Its primary purpose is to facilitate fair performance measurement, ensure efficient resource allocation, and support decentralized decision-making. By assigning revenues and costs to supplying and receiving divisions, transfer pricing influences reported profitability and managerial incentives. The challenge lies in establishing prices that balance divisional autonomy with corporate objectives. CIMA identifies 3 key goals: achieving goal congruence, maintaining divisional motivation, and ensuring reliable performance evaluation. Transfer pricing also affects group-wide tax planning, as prices influence where profits are recorded across jurisdictions. Therefore, both economic logic and ethical considerations must underpin transfer pricing policy. Transfer pricing in market and non-market contexts. Transfer pricing can occur in contexts where external markets for intermediate goods exist or where they do not. When a competitive market exists, market-based transfer prices are preferred because they reflect opportunity cost and promote economic efficiency. They ensure that internal transactions mimic arm's-length exchanges, allowing realistic performance comparisons. However, in the absence of an external market, such as specialized intermediate products, cost-based or negotiated transfer prices become necessary. Cost-based methods, e.g., variable cost, full cost, or cost-plus, ensure recoverability of production expenses but may distort divisional incentives. Negotiated transfer prices allow flexibility but may lead to conflict and inconsistent outcomes. Therefore, selecting an appropriate method requires balancing fairness, efficiency, and administrative feasibility. Types of transfer prices and their application. The main types of transfer prices include market-based, cost-based, and negotiated prices. Market-based pricing is ideal when competitive market prices exist, promoting transparency and divisional comparability. Cost-based pricing is suitable where external markets are absent, ensuring recovery of production costs while enabling internal trade. It can be applied using variable cost, or full cost plus a markup. Negotiated pricing allows divisions to set prices through internal negotiation, preserving autonomy but requiring managerial skill and cooperation. Hybrid systems may also combine these methods, using market prices as a reference but adjusting for internal efficiency or strategic priorities. The appropriate method depends on divisional structure, goal congruence requirements, and organizational culture. Impact on autonomy, motivation, and control. Transfer pricing directly affects managerial autonomy and motivation. If prices are centrally imposed without consultation, divisional managers may feel disempowered, leading to reduced initiative. Conversely, negotiated pricing enhances autonomy and fosters ownership but may introduce conflicts between divisions. A well-designed system promotes accountability by linking divisional performance to controllable outcomes. CIMA highlights that fairness and transparency in pricing strengthen motivation, while ambiguous or inconsistent policies generate resentment. Effective control requires balancing divisional independence with overall coordination. Internal performance reports should disclose the impact of transfer prices to ensure that managerial evaluations reflect genuine efficiency rather than accounting artifacts. Impact on responsibility center and group profitability. Transfer pricing influences both divisional and group-level profitability. An artificially high transfer price benefits the supplying division but harms the receiving one, potentially reducing overall group profit if internal sourcing becomes uncompetitive. Conversely, low transfer prices may motivate excessive internal demand, misallocating resources. Therefore, transfer pricing should support decision-making consistent with organizational optimization, not divisional self-interest. Group profitability is maximized when internal transactions reflect opportunity cost and capacity utilization. From a performance management perspective, the system must ensure that divisional performance metrics do not encourage decisions detrimental to corporate goals. Periodic review and alignment with strategic objectives are essential to sustain fairness and efficiency. Ethical considerations in transfer pricing. Ethics play a critical role in transfer pricing, particularly in multinational contexts where manipulation can shift profits to low-tax jurisdictions. Such practices, while legally compliant, may breach ethical standards of fairness, transparency, and corporate responsibility. CIMA's Code of Ethics mandates integrity and objectivity in financial reporting, discouraging artificial profit allocation that misrepresents performance. Within organizations, ethical transfer pricing ensures trust between divisions and maintains stakeholder confidence. Managers must consider not only compliance with tax laws but also reputational and governance implications. Ethical frameworks advocate that transfer pricing should reflect economic substance and support equitable performance evaluation. Ultimately, ethical practice sustains long-term value creation by aligning managerial behavior with corporate integrity and public accountability.